Good morning. Welcome to yet another episode of Pre-Market Commentary. Today is Tuesday, 6th August 2024. My name is Vijay. I am not a SEBI registered advisor. I do content every day on the market. If you like this kind of content, which will be slightly different from what you listen to in other media, then kindly like, share, and subscribe. So let's get to the main topic. So, was it a flash crash yesterday? So, what is a flash crash? A flash crash is when out of the blue, the news which will be there, which will be amplified, and whether there is got any connection to the underlying asset class, the market starts falling. So you don't get a flash rally, but you get a flash crash. Because what happens is in fear always overcomes greed. Now, has this flash crash happened before? I remember distinctly, I was about to go to England in 2010 May, and weekend I was supposed to go, and that particular week, there was a huge crash across the globe. We had, those days, it was about, I think, uh, things fell, Nikkei fell about 7.5% in 2 days, Hang Seng fell 5%, we fell about 3%. Dow Jones fell about 11.5% in 3 days. That was in that 6th May, Thursday, Friday, that time. And the global markets immediately recovered after that. And I had a good trip to the UK at that point of time. I was very concerned because, you see, suddenly with the out of the blue, it came. So yesterday also out of the blue, it has come. But we always find some reasons as to why the crash took place. And everybody is talking of N carry trade as if, that is the only reason. I suspect it is not the only reason. The markets were vulnerable because they had gone too far, too fast, and you needed some pin to prick that bubble. So the Japanese central bank, when they raised their interest rate on 31st of July to 0.25%, which surprised a lot of people. Actually, on that day, Nikkei went up by about 550 points. We peaked out on August 1st, and then the fall started from August 2nd onwards. Now, if you observe the charts, anybody who's looking at the charts, they would have seen some vulnerability was there leading up to the last week of July. So this was only, at added momentum, and it fell like an avalanche. So yesterday, for instance, Nikkei and Kospi, their falls are mirroring that of 1987. So there was huge hue and cry that, we are now in the 1987 scenario. So for people who were there then, I was active as an investor. I remember leading up to that week of Black Monday, we had a big fall globally, and then on Monday the whole market crashed, and Dow Jones fell 22% in a single day. Yesterday Nikkei fell about 13%. But the silver lining then was that was the bottom. The Tuesday was made the bottom. After that, the market rallied. So whenever there is an extraordinary amount of selling in a concentrated time, you can expect a relief rally. Sometimes that becomes a big bottom. Like in 2014, for instance, that was the bottom. COVID, 23rd March was the bottom. Recently, we had the election results. That was the bottom. So when there is some concentrated selling, reckless, I would say, then you can expect that the dirt would have been washed out of the system. But that doesn't mean that you will have a super rally beginning today. You will have a rally, but there will be some people who would be having margin problems yet, and they will continue to sell, which is quite healthy if the rally continues at a steady pace rather than having a V-shaped rally. So today what has happened? Nikkei has opened, and I think as we speak, it is up by about 10%, 9.5%, about 3,000 points. So this has been a reflex rally there, but that has not caught on to Hong Kong. There is a reflex rally in Kospi, not so much. In fact, Singapore is down. So there is still some uncertainty in the market. Now, if you look at what carry trade everybody is discussing, they're saying N has strengthened to 140. Yesterday it fell to 140.8. So therefore, people are withdrawing money globally because they were borrowing at zero interest rates. Interest rates have gone up to 25 basis points. So there is chaos. Now, if we just step back, always step back when something like this happens. This yen carry trade is not today. It has been going on for years, maybe a couple of decades, where Japanese held their interest rates at near zero or minus. So now they've gone into positive territory. Now, if you look at what happened in 2024 itself, we had the yen at around 140 beginning of this year, and it went up to 162 last month. So we are now at 145 as we speak. Now in 2023, the yen, the lowest, that means when lowest means the yen was stronger, it was at 128, the high was 145. We are now at 145. In 2022, it was much lower, and the high also was around that 130, 140 levels. So this strengthening of yen is not new. Markets have reacted in the past, but not so viciously. So all it needed was a trigger for the highly overbought markets. We were trading, in fact, Nifty, I think, was above 80 on the RSI. Yesterday, it fell to around 40s. Bank Nifty fell to around 30s, 33 or something like that. Silver, gold, oil, bonds, everything collapsed. This is what a flash crash does. People don't think that if I'm going to pay 25 basis points higher, can't I still do the carry trade? Because in the US, the interest rates are still high. There, the US 10-year yield is 3.8, and we are talking of 0.25 here. So still there is a arbitrage. So you can still do carry trade. It's not that carry trade is over. It's just that you now have to pay a little more, which means you would get a little less profits. But you go around selling 20%, 30% lower, it just doesn't make any sense. But markets many times don't make much sense. But it is our duty here to discern that and find the method in the madness. Yesterday, I have been mentioning throughout the day that this kind of moves will most likely bottom out today, and we should see a steady uptrend from now. Because all said and done, India is not really that affected, though people are quoting that Japan has got a huge interest in India. I've checked the facts, but 2.8% of equity holdings of FIS are from Japan, 2.8%. Kindly note that. So it is having some importance, but not the oversized importance that, the story is over. I believe this is like a tsunami. So the first wave of tsunami scares you, and then you get a relief. The second wave will be destructive. That I'm expecting it later. I'm not expecting it in this week or next week. I think this market will chug along for some time. What the markets also have done is they've woken up Bank of Japan and told them that you have to be careful in increasing interest rates in the future. If you increase, then we will collapse the Japanese economy. Most people think Fed and other central bankers are important and they make decisive decisions. But believe me, markets lead the Fed, the Central Bank of Japan, or any bank, ECB. Markets dictate the rates. So markets are telling the central bankers, be careful in what you are doing. And if you don't do it properly, if you haphazardly increase rates or decrease rates, then you will have hell to pay. I think yesterday was a good wake-up call for a lot of people, including the central banks. Now, there was this talk of, Fed will do some emergency interest rate cut. For people who know Fed has not done emergency interest rate cut excepting during COVID when the whole world was in trouble, or when it was in 2007 when there was a big crisis. Now, last year there was a crisis in the SVB, Silicon Valley Bank, but the Fed did not do anything. What they will do is they will allow liquidity speak out. As they'll allow liquidity to flow easily, they'll see that no banks have been affected. Please note that today banks are much well capitalized vis-a-vis what it was in 2007. Leverages are much lower. So the contagion effect will be that much less. I personally believe that we will get affected the least. We may get affected because we are, after all, part of the global fraternity. So therefore, one should not panic. one should look at good stocks. There are any number of good stocks available in the market for us to invest. Now, you should also remember that if Japanese investors hold stocks in Indian equities, like PSEs, they're unlikely to hold any major chunk because there's no floating stock. There are many good stocks where the FII holding is very less. So those stocks are unlikely to do badly, even if the Japanese investors want to pull out money. I don't think they will do it. They will do it if there is a further shock to the system. As of now, I'm not able to see that. So that's where we are. There's another interesting thing. Yesterday, Bangladesh, the Prime Minister ran away. She's now come to India. So there is chaos in Bangladesh. And Bangladesh and India are competing in textile exports. Now we have the December Christmas season, and exports start around this point of time. July, August, September is when they get the orders and they export. So Bangladesh does more than 2.5 times the kind of exports we do in textiles. So there could be some merit in looking at textile companies. Please note, I'm not a SEBI registered advisor. I'm not mentioning any stocks here, but just do your own homework. And incidentally, 25% of the capacity in Bangladesh is owned by Indians as far as textile sector is concerned, as per business standard. So we are not, immune, but we are also strong. Yesterday, if you look at institutional data, FI sold 10,000 shares, 10,000 crores worth of shares, but DIs stepped up to the plate and bought equal amount. So it is, even Stevens there. Yesterday, Dow Jones fell about 2.6, but Nasdaq and S&P fell more. But I think they will recover today. Gift Nifty is showing a good gap up, but we will have to see how the first hour goes and then take it forward from there. So all in all, I think there's time to heave a sigh of relief. Be watchful. Do not be led by rumors. Do not be led by assertions by people that this is going to be like 1987. If it is like 1987, then from Tuesday onwards, the market went up there. So today is a Tuesday. So have a happy Tuesday. Have a profitable Tuesday. Thank you for joining me. It's Vijay here, signing off.